Hey, it's time for a market update. The stock market has not been that fun this week. And if you look at it from the last 9 months, maybe even this year, we're almost at the end of the third quarter, but today is Friday, September 23rd. And I just thought probably a good idea to get some information out there to help you feel settled. The good news is many of you are calm. I know that because the phone hasn't been ringing a whole lot. But the more information that comes forth that makes you feel uncertain of where you are in this economic world that we are living in, you may start to lose confidence. So I'm going to give you in about 5 minutes here some great information, some reminders, some historical relevance, and I hope some alleviation of anxiety that may be coming in your own world. There's nothing to worry about. We're going to be fine. So quick market update for you here. Let's take a look. First things first, let me show you what it is that the world we're living in right now is going through. And this is a Federal Reserve rate hike cycle that we're going through. This is what's happening. When the Federal Reserve comes out and says they're going to raise rates, it can be scary. And sometimes the economic situation that we find ourselves in is that it costs more to borrow. It costs more to run a business. But they do this for a reason, and that's, in this case, to fight inflation and to, frankly, slow the economy down. That means that the stock market's going to get volatile because of the uncertainty. But the rate hike cycle is not over with. It continues. And if you look at, for the past 70 years, this is showing from 1954 through 1957 in this case, a lot of data. We're looking at June 1958 through November 59. All these times where the rate hike cycle from the Federal Reserve continued for a period of time, the stock market on average has done about 9.4%. That's not a bad return. I'm not saying that that's exactly what's going to happen during this rate hike cycle. I don't know. Neither can anybody else. But if we're using history as a bit of a guide to give us an idea of at least what's happened in the past, I hope this serves to give you a little bit of confidence that you shouldn't have to have a lot of worry. That in the past, the stock market, through trials and tribulations, works its way out. Things will come around. We just got to stay the course. So if you think this is not enough information, let me show you some more information. Because on the next slide, we have a lot to look at. But this is from JP Morgan. JP Morgan is a very well-known, reputable, and well-researched institution, but source-wise, they've gotten this information from many different sources. And what we're looking at here is the Consumer Sentiment Index. This is something that's measured, and regardless of how it's measured, just know that the average sentiment through the past 50 years, because this is taking a look all the way back to the early 1970s, has been right here, 85.6%. Or I shouldn't say percent, 85.6 is the reading. And that reading has averages, from a peak and a trough back and forth and back and forth. And so where do you think we are right now? Well, right over here, the last quarter, and we'll get a new reading here in the near future, was 50, right? Quite a bit below average. But this is the point. If we look at when we feel really good, these peak time frames, compared to when we feel really bad, right over here, about the economy, that is, then what's that reflecting in terms of stock market returns? I'll tell you, on average, what JP Morgan is showing us here is that on average, when the market hits a trough, a bottom, let me rephrase that. On average, when the Consumer Sentiment Index hits a trough, that the subsequent 12 months in the stock market actually do pretty good. This is the average return over the last 8 bottoms when people feel really terrible about the consumer sentiment. On average, about 24.9% returns over the 12 months afterwards. So I don't know where we are right now in terms of the readings. We could very well be below 50 right now. And you might also notice that that's a very low reading compared to all the other troughs. But even if we're above 50, I doubt we're above average. It just doesn't feel that way, does it? So if we're at one of these or near one of these trough points on consumer sentiment, again, as measured over the last 50 years, And if on average, during the time frame that people don't feel good, if they just stick with it over the next 12 months, the market tends to come back pretty good. That's what I want you to be reminded of. No, I'm not predicting the future in the short term, but I'm going to predict the future in the long term. And I'm going to say staying the course is probably the absolute best thing to do, given both common sense, history, and the idea that you have a diversified portfolio that plans on some times in the stock market that are going to get a little bit volatile like we are right now. So if you have questions that extend beyond these pieces of information, you can always reach me. This is the best way to reach me. You could call, you could email, and if you're a client, you are more than welcome to set up a full meeting to review everything, and we'll reach out to you if there's something that needs to be done. But my point here is to remain calm. We're going to be okay. We're going to get through this, and I do hope that you feel better after viewing some of this information. If you have any questions, let me know. We'll talk soon. Bye-bye.